introduction, Heather, and I appreciate you guys giving me the chance to talk. I am Matt Blackwell. I'm the Director of Investor Relations with Reliant Real Estate. We are a vertically integrated self-storage operator, meaning that we manage all of our own properties. We're based out of Roswell, Georgia, just north of Atlanta. And you guys are in Raleigh, right?
Yeah.
So everybody's kind of in that area?
Yes.
Okay, awesome. So we're just north of Atlanta. And I think as a introduction, I'll kind of give you the quick background of Reliant, a little bit about self-storage. I don't know how familiar you guys are with self-storage, and then kind of where we fit into that industry and how that impacts our business strategy. And then we can kind of talk a little bit about our current offering. As I said, feel free to ask questions as we're going, make it more conversational. And if there's anything I say, because Chris, you mentioned there's kind of different levels of investors. Anything you guys don't understand, interrupt me and stop me. And we'll get into, sometimes I start throwing out all sorts of industry type stuff. So feel free to interrupt me and ask what that means. So if I go down to my next slide here. This thing does not like me today. There we go. All right, because we have attorneys, I have to say everything is based on projections. Make sure you do due diligence, know what you're getting into. But Reliant, the story of Reliant, and I'm not one of the principals. I wish I was. It's an easy story to tell.
Are you able to get in?
Todd Allen and Lou Pollock are the principals of Reliant. They got together in 2007, purchased their first self-storage facility together. Both had self-storage backgrounds. Officially made it Reliant in 2010. Fast forward to today, we have 86 properties in our portfolio. We've sold another 38 in our history. And if you look at that data, this is kind of the project level data on the 38 that we've sold, just because it was structured differently with investors. The average return is 157%. So if you invest 100,000 equally across those 38 properties, you would have gotten your 100,000 back, another 157. That's certainly not what we project going forward. The last 10 years, you had to work really hard to lose money in real estate. I think the next 10 years look a little different, but there's still a lot of good opportunity in self-storage. As I mentioned, we have 86 properties in our portfolio. That makes us the 17th largest operator in self-storage. Depending on the cap rate, somewhere between 1 billion, 1.4 billion value on the properties. And the reason that's interesting on self-storage, that we're the 17th largest operator, is self-storage is a very fragmented asset class. You've got 6 public companies, Public Storage, CubeSmart, Extra Space, those guys. They own they're massive. You see them everywhere. They all have thousands of properties. They only own about 30% of the market in self-storage. 20%-ish is regional operators like us. A lot of private equity groups in that realm as well. But the interesting statistic is over 50% of the square footage in self-storage is operators who have 5 or less properties. And we kind of refer to them as mom and pops. Some of them are smaller, sophisticated operators, but it's generally mom and pops. And that's where we kind of come into our business strategy. We're buying from those smaller operators, doing value add, and then selling to the bigger buyers. And we'll get into that more a little bit. Let me show you just a little bit about self-storage. Has anybody invested in self-storage before? I'm gonna take that as a note. Does anybody have a self-storage facility or a unit? Does anybody have their own unit?
I have had, but don't anymore.
Oh, so you're smart. All right. So, and this is a little outdated. It's actually 1 in like 9 point something now Americans use self-storage. Massive industry. What's interesting is it's very little overhead. Somebody's renting a garage. We generally see people twice, when they get it and when they leave. And it's very sticky. People tend to stay there. Self-storage, oops, let me go down one more here. Looking at self-storage as an asset class, historically, this first part here, the 28-year average, 18.83% return, outperforming all the other major asset classes, looking at apartments or multifamily, office, retail, and obviously the S&P. And that's from the North American Association of the National Association of REITs. They collect all that data. Using that same data set, the reason a lot of people are interested in self-storage now is kind of become a hot item. We've been doing it for a while, and it was kind of a niche asset class. It's become much more mainstream because it's done well in downturns. Looking at the 2007 to 2009, self-storage outperformed all the other major asset classes. It was down a little bit, but it was still outperforming the other major asset classes. And I've got another slide. We'll talk about what happened during the pandemic. And then the other big reason for self-storage is that market consolidation. This happens in every asset class. As I mentioned with that fragmentation, that's where people are trying to do in self-storage now, is roll up all those smaller properties and sell them to the bigger buyers. Looking at self-storage during the pandemic, let me go here. If you look, you can see during the blue is 2020, the orange is 2021. Going into the pandemic, I'll be honest, I'd spent all this time telling investors self-storage is recession resilient. It was different. We didn't know what it was going to do. The very beginning of the pandemic, it was very kind of just stagnant while people were trying to see what was going on. And then all of a sudden it took off. If you look, industrial did fairly well during 2020 and then picked up. Office, as we all know, was down because nobody's going to the office. Nobody was going to the stores for retail. Apartments went down. The only thing that performed self-storage in 2020 was data centers. They did very well. But if you look at self-storage, 12.91 in 2020 and 79.43 in 2021. The reason for this is kind of morbid. We call it the 4 Ds of self-storage. These are things that cause demand: death, dislocation, downsizing, divorce. All of these things happen in downturns or recessions, and they create transition, and people use self-storage in these downturns. As I mentioned with the fragmentation, the Reliance play is we're buying from the smaller operators, the mom and pops. We're plugging in our professional management platform. Honestly, some of these just having due dates and late fees makes a huge difference. And then we're doing value add. So in commercial real estate, your value, as you guys know, is based on your net operating income. So revenue minus expenses. So anything we can do to increase the revenue, we're increasing the values of these properties. So we're plugging in our revenue management software. We add additional revenue sources, U-Haul truck rentals, tenant insurance programs. The public companies are doing that. The smaller operators aren't. We sell boxes, locks, moving supplies, all that's additional revenue. But our big value add is expansion. So if you're doing apartments, I'm sure you guys have probably looked at some multifamily apartment stuff. You've got to go in and renovate it and put in stainless steel appliances, hardwood floors, granite countertops. Then you can raise the rents. Now the property's worth more. You can sell it for more. In self-storage, we fix it up and make it look nice, but that doesn't make a big difference in the value. What we're doing is we're expanding. We're going to add additional square footage, whether it's 10 to 50,000 square feet, and then we're going to get that leased up. Now we've got more revenue and the property's worth more. And then we'll also slowly bring everybody up to market rates. A lot of the mom and pops, they may be charging the market rates for their new tenants, but they haven't raised rates on their existing tenants. We have a property under contract right now in Bradenton, Florida, 95% occupied for the last 3 years, I believe. And it's 74% economic occupancy. So they haven't raised rates on their existing tenants in a long time. So we'll slowly over a year bring that up to market rates, and that raises the revenue. Does all that make sense so far?
It does.
So far, yeah.
So if I were you guys and I was like, who's this guy talking about self-storage? I'd want to know what you'd done before, what we had done before. I'd want to know. Historically, I mentioned we've sold 38 properties. We used to do individual syndications. We'd find one property at a time, underwrite it, find the investors, go buy it, and then move on to the next one. 2019, we were kind of convinced that the market might start turning down. We were wrong then, but we'll eventually be right if we keep saying that. So we decided to try and risk mitigate it for our investors. Because if you're in one property and it does really well, you do really well. If it does really poorly, that's your entire investment does poorly. If you do it in a fund, it's more like a mutual fund versus an individual stock. You've got 10 to 20 properties that are bouncing each other out. So if one doesn't do well, if we miss something on it or something happens, it impacts your returns, but it doesn't destroy your investment. On the flip side, if one does really well, it's bounced out by the other properties as well, but it's a more risk mitigated investment. So we launched in 2019, we launched Fund 1. It was a $50 million fund. We ended up with 11 properties in it. We sold Fund 1 in 2021. So it was open from when we launched it, 2.5 years. Average investor was in it for 2 years, and they got about 64% was the lowest return. Average is probably much more around 68. So about, look at 32% return in 2 years. Now, I don't project that we ever exit anything that quickly again. This was perfect timing. We bought them all prior to the pandemic. We executed on the value add. that expansion, and that leased up very quickly from the demand created by the pandemic. And then on the exit side, and I didn't touch on this earlier with this fragmentation, the market consolidation, there's a lot of private equity trying to get into self-storage. So think, Blackstone type groups, and they're actually in self-storage. They bought a group in 2020. So these guys have large amounts of equity to deploy, and they're trying to find cash flowing asset classes. During the pandemic, self-storage was one of the only cash flowing asset classes. So they're trying to get into self-storage, but they want to write $500 million, $1 billion type checks. It doesn't move the needle for them to go buy 1 or 2 properties. So they're looking for bigger portfolios that don't exist. So we were able to sell Fund 1. It was 11 properties. We also had 15 individual properties that we sold with it. So it was a 26 property deal for $450 million. And that's kind of our exit strategy. We've sold a lot to the REITs because they'll pay a premium to buy a larger portfolio, because it's easier for them to buy 14 properties from us than to go do 14 individual deals. Fund 2, we launched that right after Fund 1. Mirror image, $50 million, 11 properties. That one is still operating. Right now, I will get updated numbers probably next week, but as of Q4, we're 40% above our NOI projections. That net operating income that's determining your value, we're 40% above our projections. So that one's doing very well. Fund 3, we went a little bit bigger. We ended up, it was supposed to be 100 million. I think we did about 115, 120 million. Ended up with 30 properties. We just closed that out in September of last year. So still very early in the operation, and just beginning to execute on the value add components. But as of Q4, it was 10% above NOI projections. Still got to go a little bit further to see what goes with that one. Any questions so far? All right. So Fund 4 is our current offering. Fund 4 is it's going to be $100 million. And we'll go out. My guess is we get about 10 to 15 properties in Fund 4. And now we're closer to 10 under contract now, so I'll probably say 12 to 15 properties in Fund 4. We've already closed on 4 properties. We launched this in November, so we're about $30 million into it. We've closed on 4 properties, and we have 5 more under contract that we'll be closing on. Next one's mid-May, and then kind of through the summer into early fall. Let's see if we go here. In terms of projections for Fund 4, we're seeing everybody's asked, one of the biggest questions I get is the interest rate. So when we're buying properties for Fund 3, interest rates were ridiculously low. We're writing 3s and low 3s into those interest rates when we're doing our underwriting. And with Fund 4, interest rates are higher. We're looking at 6s right now. About 6.5 is probably the average. And the banks are pulling back on how much they're willing to loan. Now, the other side of this is during Fund 3, prices skyrocketed because everybody wanted to get into self-storage. So we were paying more, interest rates were lower. Now prices are coming down because people can't get loans, they can't get the equity. So we're paying a little bit less for the properties, and interest rates are a little bit higher. It impacts our cash flow a little bit. But overall, we base our projections on a 6-year hold. Historically, we've done about 3.5 years. But everything's based on a 6-year hold because we're pretty conservative with our underwriting. Interest rates will change by then. Hopefully the values go back up. So it's a good opportunity for us to buy right now. In terms of cash flow for Fund 4, during the hold period, we project 3 to 7%. The early years, it's going to be in that 3-4 range as we're executing on the value add. As we start getting that leased up, it should start increasing and up towards the 7, hopefully eventually. With value add, your big return is when we sell, because we've added all this additional value and revenue, and now we sell and it's worth more. There's kind of, just to talk about strategies, since you guys are an investment club too, in commercial real estate, there's different levels of assets. So you have like Core Plus is a really nice first-class facility. Everything's, maybe it's an office building, everything's leased up. It's just cash flow. You're getting cash flow from it. Not a lot of upside if you sell it because you haven't done anything to change the value and it's already kind of maxed. Next, you have Core, maybe a little bit older, maybe it lost a tenant in the office building, but it's generating some decent cash flow and there's a little bit of upside. After that, you have value add, which is what we do. So moderate cash flow, we're in that 3 to 7 range, but a lot of upside because we've executed on the value add. So probably moderate on risk. Those first two asset classes, core plus, not a lot of risk, but not a lot of upside. On the other end of the spectrum is development, high risk, high reward, no and very little cash flow early on. As you're building that first 2-3 years, no cash flow, but there's a lot of upside, but there's also a lot of risk in development. So value adds kind of right in the middle, a little bit of cash flow, a decent amount of upside, and kind of moderate on that risk. Does that all make sense? Yep. So for us, 3 to 7% during the whole period, but you're earning a 9% preferred return. And a preferred return, and you guys may know this, I don't want to tell you if you do, but just in case, a preferred return is essentially what we're paying you to borrow your money. So before we're saying we're going to be paying you 3 to 7 during the whole period, but you're earning 9. And when we exit, when we sell these properties, the very first thing we have to do is return your equity. Then we have to catch you up on the difference in your preferred return. So if we've held it for 4 years and we've been paying 4% a year, there's another 5% for each year. Another, if on a $100,000 investment, another $20,000 that we owe you before we can make any money. Then after that, it goes into the waterfall split. And I'm just going to use Class C as an example. It's a 70-30 split. So if you invest $100,000, you're getting somewhere between 3 to 7 during the whole period. We sell, we return your $100,000, we catch you up on your preferred return. Then for each additional dollar, you get 70 cents, we get 30 cents. And that's where we make our money. Does that all make sense there?
Yeah. Hey, Matt, are there any fees associated with this?
Yeah, let me go down to the terms here. Yeah, so we have 4 fees, 2 one-time fees and 2 ongoing fees, and all of our projections are net of fees. We've taken this into consideration. So the acquisition fee is 2% of the all-in cost. So when we do a closing on an individual property, 2% of that all-in cost is coming out. Don't get me wrong, there's some overhead, there's some profit built into that, but it's mostly that's covering the overhead. And also for you as the investor, yes, there's money coming out of, if you invest 100,000, 2% that's coming out. We still look at your investment as 100,000. You're still earning on 100,000. We still have to return you 100,000 in equity. The acquisition fee and then the development fee is 6% of the capital expenditure budget. And that's 6% out of everybody. You're paying your pro rata share. So if it's $1 million expansion, then 6% of that is coming out for the construction to help with the construction project management team overhead. And you're paying your pro rata share of that. If there's not if there's not an expansion, we don't have a capital expenditure budget, there's no fee charged. The 2 ongoing fees are the investment management fee, that's 1% of your equity, or 1% of the equity deployed in each property. That is paid out of the property level. So that's not coming out of your money, it's coming out of the property, but that does impact the cash flow because it's coming out of the properties. The other fee is the property management fee, and that's 6% of revenues. If you guys have done multifamily, they're kind of in that 3 to 4, maybe 5 range. Self-storage is generally 5 to 6 on property management fees. This is going to our operations team, but we'd be paying this to someone else if we were paying someone else to manage our properties. Does all that make sense?
Yeah, thank you.
Yeah. But all
Hey, Matt,
yes.
Matt, can I ask you to go back for?
Yeah.
I'm sorry, I've got an echo. Is that better? Okay, sorry about that, Matt.
No, you're good.
I'm sorry, I got a phone call right around the time that you were explaining the preferred return. Can you retouch on the preferred return for just
so
a
you're
moment?
earning a 9%.
You said you're paying us back
return.
for our money at a rate of 9%. So that's not 9% plus the 3 to 7% per year. How does that work? Would you mind explaining that?
Yeah. So the day we use your money to buy a property, you start accruing 9% a year. So we'll calculate it to the day that it's deployed. So you're accruing 9%. Now we're paying you somewhere between 3 to 7 because we don't have enough cash flow to pay you that 9. But so that 3 to 7 is being subtracted out of at the end. So when we exit, we have to return your equity, and then we have to catch you up on your preferred return before we can make any money. So if we paid 4% for 4 years, you are owed another 5% for 4 years, another 20%. And we have to catch you up on that before it goes into what's called the waterfall split. Does that make sense?
It does. Does it accrue and compound, or is it?
It does not compound. It's just a straight accrual. Yeah. All right. What I will say, there's 3 different classes of shares. Class A is a $5 million minimum. It's a 9% preferred return. It's an 80-20 split. So 80 cents to the investor, 20 cents to us on every dollar. Class B is $1 million minimum, 75-25. Class C is a 50,000 minimum, and it's 70-30. All our projections are based on that Class C. What I would say is a group, if we will aggregate funds. So if you guys get together as a group and as individually, you're only doing 50,000, but you get to $1 million, we'll give everybody in that group Class B shares. All right. The other thing is there is an internal rate of return hurdle. Are you guys familiar with internal rate of return? Or would it help to give a quick?
Yeah, why don't you give a quick overview, Matt?
Yeah, so some different metrics you'll see in self-storage, and a lot of multifamily are very big on internal rate of return, or they call it IRR. That's different. So return on investment's easy. If you invest $100,000 and you get 60 on top of it, that's a 60% return on investment. The IRR takes into consideration the time value of money. So if you invested in something and doubled your money in 6 years, great investment. If you double it in 3 years, same return on investment, but it's going to have a higher IRR because you did it faster and you can put that money back to work. I'm not a big fan of it as a metric in evaluating deals because you never really know what's going to happen. All this is based on projections. We say we're holding this for 6 years. Historically, we've sold it in 3.5 years. So historically we have a very high IRR. What we project right now is about a 12 to 13% IRR. And this is the only reason I bring it up on those splits where it's 70-30. If we hit 14%, it goes to 50-50 from that point forward. And that's our incentive to overperform and to make sure we sell at the right time. Because you might say, hey, you guys are getting a 6% management fee. Why would you ever sell this? Because we make more money if we can hit that IRR hurdle. We make our money in the split. The management fee, a little bit of profit, mostly overhead. Our incentive is to hit that 14% IRR. And I would say with any deal you look at in commercial real estate, make sure your incentives are aligned with the sponsor. And that's what we try to do with that is we're incentivized to sell at the best time where we both make the most money. Any other questions on that?
Do you have properties that you hold on to a long period of time? I mean, or is your model just always to sell?
So if we had it to do over, very good question, by the way, Kelly, thank you. If we had it to do over, we would probably just never sell anything. The 38 we've sold are all worth a lot more now than they were then. But we kind of had to build that track record, and we've kind of gotten our investors used to that churn every 3 to 5 years. So they've gotten used to it. And with the value add to really get your big return, you do have to have that exit. We do have some that we've held on to that we've bought with a family office. We're partnered with a very large family office. We've bought some properties with them, and they just want to hang on to those and let them cash flow. I think our strategy now is to try and keep them in our portfolio, but still have an exit for our investors. So those private equity firms that are trying to buy from us, they want those larger portfolios. They want cash flow. They're not interested in value add. They just need cash flow. So we do the value add component with our investors like you guys. You get your big return. But with the 26 property exit we had that Fund 1 was part of, it was Harrison Street Capital out of Chicago. They came in and actually did a recapitalization where they bought out all of our investors at market rates. They got those returns. And then they kept us on as the manager, and we bought a small percentage of ownership. So we kept those 26 in our portfolio because our eventual play is, we have 86 properties and we're the 17th largest operator. We get really interesting at 150 properties for a bigger exit or public or whatever it may be then. Does that help, Kelly?
Yeah, thank you.
Yeah. Now, a question for you guys: would you be interested in a type of offering where you eventually maybe we refinance it, return your initial equity, and it's just cash flowing forever?
Yes.
Yeah. All right. So smart investors say yes to that generally, but I get a lot of no's when I ask about that. So
Because you keep your equity position, right? And but your money's no longer in it. You're just getting cash flow.
Yep. So you don't get that massive return, but you get your money back and get to put it to work. And then you're just getting returns forever. So until they eventually do something with it.
Yeah. And Matt, everyone's got to be accredited, right, to get into this?
Yes, you do have to be. Are you guys familiar with that? Would it help to touch on it?
Yes, please.
Yeah. So because we are a 506c offering, and that allows us to market this, and you do have to, the SEC requires that you are an accredited investor. That means there's some other ways to get in there, but the two basic ones are the income. So $200,000 a year income, $300,000 if you're filing jointly, or $1 million net worth, not including your primary residence. And they'll look at all your assets and the value. If you've got rental homes, the value versus the mortgage on all those. But it says that $1 million net worth or the $200,000 a year income. Also, there's some different, if you have different SEC qualifications, like you're a registered advisor or something like that, those also work.
Matt, if we got a couple people to just even do 50,000 together, would you let us come in, or do we need to create an LLC to do a $50,000 investment?
It'd probably be easiest if you do an LLC. I'd have to look at it and see. I mean, we can have that conversation and kind of see where we are.
Okay.
And Matt,
Yep.
another question, a question about the accreditation process. Who do you show that verification to? Is it the SEC or to you guys?
We just have to we are responsible to verify,
Okay.
which we don't want to do that ourselves because that's risky. Because it's basically a cover your rear. So if the SEC ever came back, something happened and wanted to look, we'd have to show that we did due diligence to make sure everyone was accredited. The way we do that, there's two options. You can get a letter from your CPA, attorney, a registered advisor that says, yep, Kelly Larkin is accredited. And then we just keep that on file. If you don't have somebody who can do that for you, we have a link to a third party service that we pay for. And they're taking the risk on that. And they have you upload, whether it's your W-2s or your net worth proof of all your credits, and they give us a verification. Once you're verified, they changed this recently. It used to be every 90 days, which was a pain. Because you'd have somebody invest at the beginning of a fund, and at the end they're like, hey, I want to invest some more, and I'd have to make them redo it. And people would get grumpy about it. They changed it recently, though. If we've done the due diligence, it's good for 5 years with us.
Oh.
Okay, cool.
Anything else? What else would be helpful? I feel like I skipped some stuff, but I don't remember. Heather, I've talked to you before. Did I skip anything that I told you?
No, I think that's a really good overview of how, how Reliant works, your background. If they want to invest, is it all an online process, or maybe walk us through, hey, today I decided I want to invest. What do I do now?
Yep. So if you want to invest, you can also scan on that QR code there, and that'll get you in our system. You get an email from us. And I think it takes you, don't hold me to this. I haven't scanned this QR code recently to where you can commit there. But basically, just let me know. My contact info is right there. You guys just reach out and say, hey, Matt, I want to invest. And then I will turn you over to our Director of Investor Services, Dominique Rodriguez. She'll send you a link to our investor portal, and she'll also reach out to you, and she's happy to walk you through the process. She's much better at it than I am. That's why we have her. And she'll get you through your subscription documents, your accreditation, and then we'll send you the wire instructions. And then you go ahead and fund. And then once we deploy that equity, you start earning your preferred return. Some people take a month to do it, and I've had people do it in about an hour. So it just depends on you. But it is all online. We have that investor portal. You'll get quarterly reports from us. You'll see them there. You'll get your K1s there. And then the nice thing about these type of investments, you guys know this, I think, but you're a phone call away from your money. So I'm not going to dump you off to Dominique for that, and then you never hear from me again. I'm the person you talk to update, hey, what's going on with my investment? What's going on with these properties? Always happy to chat about it.
And Matt, since it's a fund, we cannot do 1031 money in this, correct?
Correct. You cannot 1031 into a fund because your name has to be on the title of the deed with the 1031 requirement. What we do, if someone has a 1031, we can 1031 you into an individual property that's in the fund. We do have $1 million minimum on that just because there's a lot of legal fees and it's a hassle, but it's a great way to do it. If you guys aren't familiar with 1031s, great way to build your wealth and avoid taxes. So what we would do if we get our closing coming up, you have $1 million, say it's a $10 million property, you own 10% of that property and the fund owns the other 90%. We would do a tenant in common structure.
Hey, Matt, besides a 1031 tax savings, are there any other advantages on the depreciation that we can take?
Yeah, so any depreciation is passed on to you in a pro rata share. What I will say is self-storage has less to depreciate than some other asset classes like multifamily and hotels, because we're a metal box on a concrete pad.
Right.
So I think Fund 3, just because I was looking at this for an investor, was about 14% depreciation last year. We'll do cost segregation studies, and we'll get when we do that, we get maybe 20 to 30% depreciation, but we don't do them all at the same time because we're doing it when we complete the value add to get the most bang for the buck. So you're not going to see 20 or 30% depreciation at the fund level because it's only happening on maybe 5 properties out of the 15 to 20.
Right. Is that per annual, or is that at the end of, say, the exit when you sell?
That's annual, and that's early on in the early years. I'd say year 1, 2, maybe 3. Your K1 is going to be negative. You're going to be seeing some depreciation. Now there is capital gains recapture tax, so that's all going to get caught up when you sell, unless you find a way to 1031.
Okay. And then, so Fund 4 has already started. Is that correct, or is it about to start?
Correct. We launched it in November, and we've already closed on 4 properties, and we've raised about 30 million.
Okay. Sorry, I came in late, so.
Nope, that's all right.
For that. And then is there a window as far as when you're going to close? You're taking new investors?
Yeah, generally we try and keep it within a year. So we launched this in November. My guess is somewhere late fall, end of the year, we'll close this out. And it takes us about a year to raise 100 million. The other thing I'll say too is we do have some leeway with that. If we're at 50 million, 70 million, and we see a change in the market where we don't think it's a good time to buy, we'll stop there. We're not going to buy something just to buy it. And at the same side, this happened with Fund 3. We were about to close it and we got a really good deal on 2 properties. And so we didn't have time to launch another fund. So we kept it open and added a couple more properties and went to about 115.
Gotcha. Thank you.
And I just realized are there questions in chat?
I think we got them. Let's see.
Is there anything? I see stuff in there.
Yep, I think it was just about
Accreditation.
Yeah.
Okay.
All right, I think, are we good, everybody?
Just one last quick question from me, Matt, as you had mentioned earlier about the idea of a fund that would refi out after a couple of years and then have a continual flow. Were you talking rhetorically, or do you have a product in mind coming up that would be that metric?
We're always considering everything. That's why I ask investors what they like. My guess, and we're still ways out on this, is the next fund we might do an open-ended fund. So this is a closed-ended fund. Once we get the last amount of equity and last property, there's no new properties being bought in the fund, no new equity coming in. Your investment is illiquid. You can't get your equity back until we sell because there's nothing to replace it with. We've considered doing open-ended funds where it just stays open. We're always buying properties, and maybe at certain periods, maybe there's a 2-3 year lock-in, then quarterly or yearly, you have the option to get out, and we do net asset value. We looked at it for Fund 4 and it just got so complicated. There's a lot that goes into it, and we said we've done well with this structure, let's stay with it. We might change that. We are now on the Fidelity and Schwab platforms, and so if any of you guys have a wealth advisor or a registered investment advisor, you can use them through Fidelity and Schwab to invest in Fund 4. But those guys like the open-ended funds, and now that we're kind of moving in that direction as an additional equity source, the next one might look a little bit more like that. And that way you would also be able to compound your investment. So you could take your distributions, or they could reinvest, because we are continuing to buy assets. Right now, you can't reinvest your distributions because we're not buying anything else. But with this, you could just let that compound. So, and the last thing I'll throw out, I don't want to take too much else time. any real estate deal, whether it's us or somebody else, my advice is always to look at the team, the track record, and the underwriting. Is it conservative? And the team, have they done it before? Can they do it again? Because it really, you're investing in a certain asset class, certain property, but the team is what makes the difference. When the market's changed, and there's I've seen some interesting stuff in multifamily right now. When those markets change, you've got to rely on that team to execute on that business plan and make the best decisions. And the track record doesn't necessarily mean that they can do it again, but they've got a history, they've done it. And I will say the last 10 years, I think everybody's probably got a good track record. Next 10 years, I think we're going to see some changes in that. And then the underwriting, and this is probably the hardest part to see. There's a lot of variables in the underwriting that we can change and make the returns look ridiculously good, but it's all fake. It's all made up. One of the quotes we use in the office is more fiction has been written with Microsoft Excel than Microsoft Word. So, and some people are like, well, why can't you give me to 20%? I was like, well, I can go change some of the underwriting assumptions and we'll get you 20%, but it's not real. So that's what I say. And that's an indicator. If they're aggressive with their underwriting, they might be aggressive in other things as well. So that's kind of how I evaluate deals that I look at. So that's just kind of my 2 cents worth there.
And you guys were you saying that you're conservative in your underwriting?
Yeah, we try to be really conservative. As I mentioned, our historical track record, we've sold in about 3.5 years. We underwrite out to 10 years, and year 6 looks kind of like when we maximize our revenue, because we're pretty conservative with the rent growth, building some buffer for construction because things always happen. So we kind of look at year 6. Historically, we've outperformed that, but one of the biggest metrics you can change is the cap rate. If you guys are familiar with cap rates, if somebody's using the current market cap rates for their exit, probably not accurate. But also, who knows what cap rates are going to be in 6 years? It's kind of hard to project. We try to build in cap rate growth. So we're saying that self-storage is going to be worth less in 6 years when we sell, but we're still able to get a profit because we're forcing appreciation into it with the value add. And we could change that and use the current market cap rate, and our returns would look ridiculous, but I'd be lying to you. And for us, there's no reason to do that. We've got a strong track record. I have to deal with you in 6 years. I don't want you yelling at me. So
From now until the next 6 years, you don't want to be yelled at? That's weird. Hunter, did you have something?
I did. I just wanted to clarify, if we bring multiple people in together and form an LLC to invest, we are still interested in seeing evidence from each of those individuals that they are all accredited. Is that correct?
Yes. So the way the law, and once again, if you have a CPA or somebody, consult them. I'm not an expert, but the regulation is that if it's an LLC, all the members have to be accredited, or I think it's like if there's $5 million in it or something like that.
Okay. And do you have, when you have groups like that come in, do you have any kind of requirement as far as the minimum investment per individual in the LLC?
No, so if you came in as an LLC, we're looking at that as one investor. For us, that LLC is the investing entity, so it just has to be at the 50,000 minimum.
Gotcha. Thank you.
Hey, Matt, are you recording this? Can I get access to this again?
We're recording it, Steve, so we'll have a copy of it shortly.
All right. Thanks, Chris.
And as I mentioned, you guys can click or use the QR code there to get into our system. But also, if you guys are interested, I'm happy to, if Heather or Chris wants to get an email list together, I can add you guys to our distribution list, send you our investment summary. And then also we send out some weekly emails with just market updates, what we're seeing in the market. If we getting new properties under contract, kind of updates on that kind of stuff.
Cool.
Sounds good, Matt. Does anyone else? Kelly? You look like
No, I'm
no.
good.
Okay. I think that's all then. Matt, really appreciate your time. Thanks for the overview. Very useful and very helpful. And I think we'll all probably talk amongst ourselves and figure out if we want to do something.
Sounds good. Well, Heather, I appreciate you setting this up, and thank you for the time. Chris, thank you for organizing, and it's good to meet all of you. Thank you for your time.
Absolutely. Thank you. You're always welcome.
Thank you so much.
Thanks
All right.
everybody for jumping on, and we'll have a meeting sometime later this week, and we will talk about this in comparison with some of the other things that we've looked that. So thanks for jumping on today.
Sounds good. Y'all take care.
Thanks, Matt.